Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And I have some exciting news for everyone today, because for the next few weeks, we're going to be doing something a little bit different with the show, putting a pause on the ongoing Becoming Buffett series we've been doing on the podcast, because on June 27th and 28th of 2017, just a few weeks from now, we're going to be having our mid-year DIY investing summit in partnership with Seeking Alpha. And it's going to be an exciting summit. We're going to have a lot of some of my favorite investors from Seeking Alpha are going to be a part of this summit, and we're going to have all kinds of topics, everything from what their favorite picks are, specific favorite investments are going forward from here, how they're shaping their portfolio for the second half of 2017, how they're hedging their portfolio in light of markets being at all-time highs, as well as how they go about identifying major trends and how do they identify companies to invest in, how do they research them, how do they make buy and sell decisions, all that stuff and more. So I hope you enjoy this preview of the DIY Investing Summit, and you can register for the summit for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com for your free registration. Well, hey, Travis, welcome back to the DIY Investing Summit.
Hi, Brian. Thanks for having me.
How are you positioning yourself for the second half of 2017? Anything particularly you're excited about or concerned about, especially in light of your inflationary thesis?
Yeah, I think there's going to be, the first half of 2017 so far has been a turn away from that inflationary thesis. You know, people embraced it in the second half of 2016. I think the second half of 2017, you're going to see a return to that as growth in the U.S. accelerates. I think you're going to see nominal GDP, much higher than what it was in the first quarter, but you're also going to see growth in Europe. It has been accelerating, and the same for Asia. So I think you're going to see bond yields will be higher. Sovereign bond yields will go higher. I think the U.S. 10-year Treasury could challenge 3% or 3.5% this year, or maybe early next year. And I think you're going to see sovereign bond yields rise in the rest of the world. They're still very low in places like Germany. For example, a 10-year Treasury in Germany yields 0.3% right now at 30 basis points, roughly. And, if you have 5 or 6% nominal GDP growth, it doesn't, those two things don't go together. Something has to give. And I think you're going to see rising bond yields. But, as that happens, the reflationary thesis will be re-embraced. And, John Templeton likes to say in a bull market, you have these stages where you have pessimism, skepticism, and optimism, and euphoria. Well, in the U.S. market, you could say that, for certain sectors, we're in that euphoric stage, but in the inflationary equities, I think we're very early in the bull market there. We're probably in the pessimism, skepticism stage, still. Optimism started creeping last year, but it went right out. And the nice thing for investors is, as that optimism comes into the market, you're going to see much higher prices in those inflationary assets.
So you said pessimism, skepticism, optimism, and euphoria.
Yeah. So, and if anybody's listening to this, think of whatever sector or stock you're interested in, and think of where they might fit along that scale. And I think you can make an argument, in the U.S., for example, that with the large cap growth stocks, that we're definitely in a euphoric period, and the U.S. market as a whole is probably, pretty optimistic right now, even though I would say this bull market in U.S. equities has been one of the most disliked bull markets in history. And,
yes,
that's probably the reason it's been one of the longest bull markets in history. But, we've certainly had some optimism, come into the market, particularly in those large cap growth stocks.
Yeah, I would say that's definitely a theme that I feel like I've seen in terms of what I follow, that there's been, like you said, I mean, the pessimism and skepticism has been, it's defined this bull market in my experience, in my opinion. But it feels like the last several months or so, the tone of things seems to definitely be shifting over into optimism as a whole. There's still concern and stuff, but I see that shift to optimism happening right now as well.
Yeah, and so if you're looking at the market as an investor, you want to say to yourself, where is the optimism and euphoria? And generally, those things you should be selling or rebalancing. And then you want to say, where is the pessimism and skepticism the heaviest? And those are the areas that as a strategic asset allocator that you want to be allocating to. And then when you're tactical, or you're looking at individual equities, that offers some more opportunity, I think. But generally, it's the old Buffett axiom. You want to, sell high and buy low. And it sounds easy, but in practice, it's hard to do.
But that scale is really helpful. And obviously, I know you didn't invent that scale, and you're not the first person to talk about that scale. It's like the whole blood on the streets type idea. But that is helpful. I mean, just that 4 points: pessimism, skepticism, optimism, euphoria. Because it's so hard to sift through the emotions when stuff's happening. Like, for example, I've got an asset that has been performing extremely well, and it's one that I have intended to hold for a very, very long term, but it's performed so well that I keep wanting to sell it because I feel like it definitely feels optimism and euphoria are winning the day. But then but it's so easy once you're in that to let the emotions think, well, but what if it goes higher? What if there's more good times to come? And so on and so forth. But having some kind of a scale like this, it makes it a little bit more objective. And I like that.
Yeah. And just having then the discipline to rebalance. And, there's investing is art and science. And there's always I like to tell, in our service, and members of our group, a phrase I like to use a lot is that you want to buy right and then you want to sit on your hands. So, oftentimes we overtrade. So you want to let whatever people spend a lot of research developing something, and when it starts to move in their favor, you don't want to automatically rebalance, but you want to sit on your hands and let that asset run. I think that's one key to outperformance, especially with stocks. If you're holding over the long term, certain equities can have extraordinary percentages if their business is compounding and growing. And having said that, though, if you're in a euphoric stage, and I think certain areas of the U.S. market are, you could argue that there's a short-term speculative mania in cryptocurrencies, Bitcoin, like that. That's when you want to, I think, have the discipline to periodically rebalance out of those assets when the euphoria is there. But as you said, it's hard to recognize when you're in the midst of it. You think that how many people got out of the housing market in 2005, 6, 7. Not many, because it was. The euphoria went on, and it was almost a complacency that developed. So it's in practice, it's hard to do to rebalance.
It's extremely hard to do. That's why I think there's a lot of things that can be helped, but that scale you mentioned is just helpful to make it a little bit more objective. Is there any one specific investment right now that you have the highest hopes for? Like, if you could put your money in one place right now, what would your most highest hopes be for?
Yeah, I'll say a sector, and I think natural gas equities in the U.S. are very attractive. And the reason is, they're out of favor. There's a belief that we have this never-ending supply of natural gas in the U.S. However, because prices have been pretty low, there hasn't been capital investment in the sector. So supply is actually challenged right now, but you have demand that's growing by leaps and bounds because we're exporting more, both to Mexico and through liquid natural gas exports. And then, the second part of that is natural gas has displaced coal as the primary source of electricity generation in the U.S. And coal will gain back some market share. Coal is probably an interesting investment too that we can talk about. But natural gas is viewed as a cleaner fuel. It is cleaner, and it has a tremendous tailwind at its back. For the next several years into the foreseeable future. So I think natural gas equities are a terrific opportunity right now. That most people know that or know the dynamics, but they kind of discount it. But I think it's right under, people just gloss over it. It's right there. But when you look at the supply-demand dynamics, it becomes apparent of how much of a bargain natural gas is and how much of a bargain the natural gas equities are.
Do you have a favorite equity in that space?
There's a number of them that I like. It depends on your risk tolerance. One of my favorites, I'll discuss briefly, but it isn't for the faint of heart because they have some leverage on the balance sheet. But it's Chesapeake Energy, which is, believe it or not, they're the second largest natural gas or natural gas producer in the U.S., right behind ExxonMobil. Just right behind them. They still have some of the best acreage in the country, and they're producing a fantastic amount of natural gas without really reinvesting into the business. That tells you how good their fields are right now. They haven't put a lot of capital into the business the last several years. They're actually redirecting capital into their oil drilling, which they believe has higher rates of return with where oil prices are. But the reason you want to own Chesapeake is their natural gas exposure, and they're a discounted, distressed company. But as that changes, and I think anytime you own an individual equity, you want to look at what management's doing, and I think they have good stewardship there. That is a transition from prior ownership. I think they've got a couple significant institutional investors that are on board, and when an asset or a stock or a company is depressed in price, all it takes is a little optimism coming in, like we said earlier, and the share price can really go much higher. And I believe that's the case for Chesapeake right now.
Well, I hope you enjoyed this brief interview preview from the DIY Investing Summit. And if you enjoyed anything about this and found any value in it, I assure you, you will thoroughly enjoy the full interview. And you can register for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com. And free registration, and then the summit goes live on June 27th. And so look forward to seeing you there. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.